We all look at the stock market, right? We read the quarterly reports and we see these massive revenue figures that companies like Walmart or Apple announce.
Right.
That's the public scoreboard. It's the final audited score for everyone to see. But what if I told you that the real competitive game, the one that actually determines who wins and who loses long term, is played entirely behind a locked door, using data that investors like you and me, we never ever see?
That's a perfect way to put it. If financial accounting is that public scorekeeper, documenting the historical results for outsiders, investors, regulators, then management accounting is the private playbook.
The private playbook. I like that.
It's the proprietary data the internal team that coaches the players use every single day to actively plan, control, and execute their strategy.
Okay, let's unpack this. Our mission in this deep dive is to get inside that private playbook. We want to understand the critical differences between these two types of accounting and how this internal data creates this massive silent competitive advantage. We'll look at everything from, say, the DuPont revolution to modern giants.
And the core concepts that make it all work.
Exactly. And the ethical foundations that have to hold it all together. Think of it like this. For a basketball team, we're going to ignore the public scoreboard for a bit and dive deep into the internal analysis, the shot charts, the player tendencies, the real cost of every minute played.
We're basically moving from just reporting on history to generating data that's designed specifically to shape and control the future.
So let's start there with that fundamental divide. What really makes management accounting so different from the balance sheets and income statements that the public sees?
The differences are, well, they're absolute.
Yeah.
And completely intentional. It's all driven by who the information is for and, why. So take financial accounting, or FA. It's built from the ground up for external reporting. Its users are all outsiders.
Right. Investors trying to allocate capital, banks.
Exactly. Investors, banks deciding if they should lend, regulators demanding consistency. Its primary purpose is really about external resource allocation.
Which means it has to be super standardized. You have to be able to compare Apple to Microsoft reliably.
That's it. It has to follow very strict standards, like JAP, Generally Accepted Accounting Principles, or IFRS. It's necessary for that external comparability and consistency.
And that forces it to be backward-looking.
It does. It forces FA to be past-oriented. It's reporting on what's already happened. It is the historical scorekeeper, and its number one job is to be consistent.
So then management accounting, or MA, just flips that whole script.
Completely. Its primary users are the insiders, the managers, department heads, the executives running the show.
Okay, so the purpose is totally different.
Right. The purpose is internal decision-making. Things like planning for next year, controlling operations right now, and evaluating how well your own teams are doing. And here's the absolute core differentiator.
What's that?
MA has no mandatory external rules, none. It doesn't need to be consistent with what competitors are doing. It only needs to be useful and relevant for the manager making a decision, like right now.
Wait, you said MA has no mandatory external rules? I have to ask, isn't that a massive vulnerability? I mean, if the data is all proprietary and there are no regulations, how can a CEO or even VPs really trust that a divisional manager isn't just massaging the ROI numbers to look good? Especially knowing there's no auditor coming to check their internal work.
That is a fantastic and critical question. We're definitely going to get to the ethical solution for that later on. But just from a structural point of view, that lack of external rules is actually its greatest competitive strength.
How so?
It allows the system to be flexible, tailored to the specific problem, and instantaneous. FA can take weeks to compile historical data. MA can give you a profitability report on an item that was sold 5 minutes ago. So it's future-oriented through things like budgeting and forecasting, but it's also extremely present-focused for immediate operational control.
Okay, so if FA is standardized history, MA is custom proprietary strategy, and that jump from scorekeeper to a competitive tool, that's where this gets really interesting. Because it's not just about tracking money, is it? It's about making better strategic decisions that can fundamentally outmaneuver your competitors.
It creates a silent advantage. A simple example we've seen is in competitive bidding.
Like for a construction project.
Exactly. If a construction company uses MA to track its costs internally with incredible accuracy, not just materials, but say administrative overhead per project hour, they can submit a bid that's aggressive enough to win the contract.
But still secure enough to guarantee a profit.
A profit that competitors, who might be relying on simpler data, just couldn't match.
they can hit that profitable sweet spot because their internal understanding of their own costs is just flat out superior to everyone else's.
Absolutely. But to see how this can transform an entire organization, we have to look back maybe a century ago to the DuPont company.
Okay.
By the early 1900s, DuPont had vertically integrated. They had these complex, very diverse business segments. I mean, everything from raw material mining to explosives manufacturing to nationwide sales networks.
That sounds like a management nightmare. How do you possibly compare the performance of a mining operation to a sales division? They have totally different assets, different revenue streams.
That was the exact problem. Simple manufacturing accounting, which just focused on total production cost and profit. You just couldn't plan, control, or evaluate this diverse empire. Donaldson Brown and other DuPont executives, they needed a solution. A tool that would force managers to think about corporate health, not just their own department's profit.
And the tool they came up with.
It became one of the foundational frameworks of modern business. Return on investment analysis, ROI.
Okay, let's stop there for a second. Before ROI, management was mostly looking at just total profit, right?
Exactly. You might see one division with a huge profit and just declare it a success. But ROI forced managers to evaluate not just the profit being generated, but also the assets required to generate that profit. It revealed the hidden cost of capital that was tied up in, slow-moving inventory or giant inefficient factories.
So they could have a massive division making huge gross dollars, but if it was tying up 90% of the company's total capital, they wouldn't even know it was capital inefficient until they calculated ROI.
That is the power of MA. It reveals opportunity cost, and it forces a uniform discipline across totally diverse segments. And the aha moment was profound. They found that a sales division earning a 10% ROI was actually twice as efficient in using capital as an explosives plant, earning a 5% ROI.
Even if the plant's dollar profits were higher.
Even if they were much higher. ROI became the single, clear metric to guide capital allocation and resource efficiency. It transformed their complex structure into a manageable, competitive machine.
That's a powerful historical example. So let's contrast that with a modern giant like Walmart. Financial accounting gives us one enormous aggregate number, worldwide sales. Useful for an external investor, sure.
But the CEO can't run the company on that one number. Walmart needs segmentation. Their management accounting system segments sales by store, by department, by item, by the time of day, customer demographic, profitability per item.
And even correlation with ad campaigns.
All of it. This level of granularity is what supports their operational control and their decision support.
I get that they track everything, but can you give me a specific, actionable insight that only this kind of granular MA data could deliver?
Okay, consider this. Financial accounting would tell them the profit margin on winter coats is, seasonal, obvious.
Right.
But their detailed MA models, which are tied to regional inventory and predictive weather modeling, might reveal something else. It might show that increasing the inventory of heavy winter coats in July in specific northern regions actually maximizes late summer profit.
In July? Why?
Because customers in those areas are buying early at a higher margin, just anticipating availability later. That decision, which is totally counterintuitive to traditional seasonal stocking, is driven entirely by segmented proprietary MA data that's forecasting localized demand and maximizing profit per square foot.
That's brilliant. It turns a single historical number into 1,000 forward-looking, location-specific insights. That is the true competitive edge in retail.
It is. It's what separates a global leader from a company that's just reacting to last quarter's results.
So we've seen how MA created a decentralized empire at DuPont and how it drives supply chain decisions at Walmart. It's clear the system needs its own language for internal communication.
If I'm a new manager, what are the foundational terms I need to master? Let's look at the manager's toolkit.
Okay, so the toolkit really focuses on two things: accurate measurement and future planning. And the most fundamental tool is product or service costing.
So just figuring out what it costs to make something. It's determining precisely what it costs to produce an item or deliver a service. But we're not just adding up materials and labor. We use much more advanced techniques.
Such as
Activity-based costing, or ABC. This is crucial because it accurately ties all those complex overhead costs, like the IT department's time, or the facility maintenance team, or quality control resources,
to the specific products that actually use those resources.
Exactly. Without ABC, overhead is often wildly misallocated. It makes high-volume products look artificially expensive, and small, complex products look artificially cheap, and that just leads to bad pricing decisions.
So ABC ensures we know the true cost before we set a price. And if we're launching something new, we need to know the point of survival.
Which is break-even analysis.
Correct.
This calculates the sales volume you need just to cover all your fixed and variable costs. It's absolutely critical for testing the viability of any new business line or product launch before you commit significant capital.
And the break-even results, they feed directly into the next key concept, which I assume is budgeting.
It is. Budgeting is the numerical plan. It's the formal process of creating a detailed plan for future operations, revenues, expenses. This is the heart of the planning function.
But it's more than just a plan, right?
Yeah. Modern MA uses budgeting as a dynamic control mechanism. Managers track variances, the difference between the budgeted cost and the actual cost to signal if operations are deviating and need immediate action.
That brings us right back to DuPont's ROI. Once the plan and budget are in motion, we have to see if it's actually working.
Exactly. And that requires performance evaluation. We use metrics like ROI, residual income, or EVA to measure and motivate employee and department performance against those goals. It's about accountability.
And all of this is built on.
Underpinning all of it is the necessity of segmentation, which we saw with Walmart. Breaking down that massive aggregate data into meaningful categories by product line, region, customer type, that's the only way to get true profitability analysis and know where to put your resources.
So if we sum all these tools up, management accounting really supports three key processes for management: planning, controlling, and evaluating operations. It's like a closed-loop system for continuous improvement and strategic growth.
Precisely. And because these tools are so powerful and the data is so detailed, proprietary, and highly confidential, we have to address the governance issue. We have to talk about ethics.
This is so important. Financial accounting is externally audited. It's highly regulated by GAAP and IFRS, but MA is, by design, unregulated by external bodies. Since it relies on management for accuracy, why does ethical conduct matter so much here?
Because the entire integrity of the MA data, the whole internal playbook, it relies entirely on the ethical conduct of the people preparing it.
There's no backstop.
And no backstop.
Yeah.
If a manager manipulates internal data, say, intentionally lowering the ABC overhead allocation to make their product cost look lower, or fudging budget numbers to hit a bonus target, there is no external auditor who's going to catch it. And the company is now making major strategic decisions based on lies.
And the consequences of that must just ripple throughout the entire organization.
They do. Manipulation of internal cost data, budgets, performance reports. It can lead to disastrous strategic mistakes, misallocation of capital, and really unfair treatment of employees whose jobs might depend on an internal performance evaluation.
And the accountants themselves have access to everything.
Everything. Management accountants have access to those sensitive corporate data, private customer buying patterns, strategic pricing plans, even which low ROI plants might be on the chopping block.
That is an incredible amount of power. So how do organizations ensure integrity when the whole system is custom and proprietary?
Organizations globally, guided by bodies like the Institute of Management Accountants, they uphold these core ethical principles that basically substitute for external regulation. For instance, confidentiality is paramount.
Meaning you can't share what you know?
You cannot disclose sensitive internal information. You can't give a supplier your proprietary product costing data, for example, or misuse private customer data that you gathered from your segmentation analysis for personal gain.
And what does integrity look like in a management accounting context?
Integrity means avoiding conflicts of interest and communicating information fairly and objectively, even when it's painful.
Give me an example.
Okay, imagine you're asked to analyze the profitability of a segment that's run by your best friend. Your MA data shows that segment is losing money and should probably be cut entirely.
Oh, that's tough.
Integrity means you present that data objectively without manipulating the segment reports to make that project look better, even if it might cost your friend their job or their bonus.
That really grounds the principle in a high-stakes scenario.
It has to be. And finally, there's competence, maintaining your professional skills to make sure the models and information you provide are accurate and relevant. And credibility, which requires disclosing all relevant data that could influence a business decision, not just the data that happens to support your own recommendation.
It's a high-stakes competitive sport, and it relies completely on the professionalism and ethics of the internal team.
That's it.
That is a fantastic synthesis. For you listening, the core distinction should be clear. Financial accounting is the public rulebook for the spectator. It's the public scoreboard. Management accounting is the custom, private playbook filled with proprietary strategies used daily by the coaches and players to win the competitive game.
And that playbook, Driven by granular data and internal insights like ROI and activity-based costing, is truly the primary source of competitive advantage and, honestly, company survival.
So here's something to mull over. We've highlighted the immense power of this detailed proprietary internal information. If this non-standardized management data is the core driver of competitive advantage and a company's survival, what ultimate accountability does a company owe to its employees, its investors, the market, to ensure that this critical, confidential information is truly accurate and ethically sound? Especially given its immense power over individual jobs, strategic investments, and the entire direction of the company. The integrity of the unseen truly determines the success of the visible.
A question that really defines management responsibility in the 21st century.
Something to think about until our next deep dive.